Corporate Finance OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote. This will be the second problem of its kind. This is going to be part 2 of the second problem of its kind, where we're going to be focusing in on the degree of operating leverage, degree of financial leverage, and the combined leverage. Last time, we focused in mainly on the degree of operating leverage. Now we're going to spend more time with the degree of financial leverage and then the combination of the two. Get ready. It's time to take your chance with corporate finance. Here we are in OneNote. If you would like to follow along in OneNote, you're not required to do so, but if you have access to it and would like to, we are in the 521 P1 second degree of operating leverage, degree of financial leverage, and combined leverage part 1 tab in the practice problems section. Closing this back out, we're going to have our information up top. Now note this is the second part of this problem, so if you haven't seen the first part, you might want to go back and check it out. We focused in on in it the degree of operating leverage, the leverage related to the breakout between basically variable costs and fixed costs. The more of the fixed costs we had, then we could see the leverage typically will increase as we lean over to the fixed costs as opposed to the variable costs. Let's scroll on down now. We're going to be moving on down and thinking about the leverage relation to the financial leverage, which is going to be on down here. And then we'll take a look at that operating leverage when we do the combined leverage and combine the two together into that one calculation. So we're going to be on down here. We got our income statement on the left-hand side. This is going to be basically our starting income statement, the primary scenario. The degree of financial leverage is going to be either the percent change in net income divided by the percent change in earnings before income and taxes, earnings before interest and taxes, or we have the earnings before interest and taxes divided by earnings before taxes. This first one is kind of that percentage change formula that you might use in some cases, but we're going to be focusing in on the second item. And notice this first one, you might be using that in the case possibly where you're an outsider and you're trying to use financial statements that are from a company rather than having the internal financial statements that are going to be in a contribution margin type format, although that's not as necessary because typically even in a normal kind of income statement, you'll have or be able to pick out these two numbers on it, unlike the degree of operating leverage where it might be more necessary to do this kind of percent change type of formula. So we're going to be focusing in then down here. We do have our income statement. It's in a contribution margin format in that we have the sales minus the variable costs, which would give us the contribution margin, as opposed to like sales minus cost of goods sold, which would give us the gross profit. So we're breaking this out by behavior as opposed to by what they are used for. So let's go through this. We're going to do this in our kind of tax return type of format. Instead of just plugging the numbers into the ratio, we're going to basically be breaking each part out, each numerator and denominator out, so that we have the end result in the outer column. It should be fairly basic because both these numbers are basically on the income statement. So we got the earnings before the interest and taxes. That's going to be this number. Could be operating income. In essence, operating income would be the same on a normal income statement. And this income statement, which is the contribution margin type of income statement, typically. Then we've got the earnings before taxes, which we can calculate as earnings before interest and taxes minus the interest, which is actually done right here on our income statement. If you have a multi-step income statement as well, operating income, in essence, earning before interest and taxes minus the interest gives us the earnings before just the taxes. So we're not quite to the bottom line yet, but only the taxes being the difference. So if I subtract these two out, we're going to get that $180,000, which is the earnings before taxes, which is actually right on our multiple step contribution margin income statement. So then if we divide those out, we now have the numerator and denominator in the outer column. We're going to take the 250,000 divided by the 180,000. Let's pull out the trusty calculator just to make sure that this thing is, see if it's even or not. 250,000 divided by the 180,000. So it's actually 1.3888. It's going to round to 1.39. So we do have to deal with the rounding as a factor here. Now, obviously, the degree of financial leverage has to do with basically the debt. And so that's what most people kind of think about with leverage. Why? Because the difference between the numerator and the denominator is the interest, which in essence is the rent on the purchasing power of money. So a loan, we got a loan we took out and we had to pay basically the rent on it, interest payments on it. That's what we're focusing in on here. Like with any kind of leverage calculation, as that goes up, that means the leverage is going up, which means that the risk is going up. but also the possible benefits of having more leverage could go up. Those being that if you were to have increases in good times, it could have a multiplier effect. In bad times, it could have a multiplier effect in the negative. So you could have the goods and bads with it as well. Now, what if we did this change? Because we did this kind of combination when we looked at the operating leverage, where we made this second component and said, well, what if we changed the earnings before interest and taxes to still be the $250,000 as is our normal or our first scenario, but rather than having the variable cost at 40, fixed costs at the 350, we're going to say now that the variable costs are $10 per unit, and we increase the fixed cost. So we're at the same bottom line number as far as operating income, but we have a different breakout between the fixed and variable costs. Now, this will have an effect on the operating leverage, as we saw, because that's the leverage that has to do with this risk of having more fixed costs that can't change. The fixed costs will not change as we increase or decrease sales. So when we increase sales, we don't have to pay any more. That's good. That can result in a multiplier effect. When we decrease sales, we still have to pay it, which means it could result in a multiplier effect on the negative side of things. That's what the leverage does. Not going to have an effect here on the degree of financial leverage. It will have an effect on, of course, the combined leverage when we combine the two, degree of operating and degree of financial leverage together. So let's take a look at this. If we do the same calculation, we're going to come out to the same number for the degree of financial leverage, meaning the earnings before interest and taxes are going to be the numerator, the 250,000. That didn't change, right? We're still there, the 250. We just had a different breakout between the cost structure, variable cost and fixed cost. The earnings before taxes is going to be the earnings before interest and taxes, the 250,000 minus the interest, 70,000. That's going to give us then the earnings before taxes, which was actually just on our income statement, but it may not be on there all the time. In some cases, you might have to back into it the other way. You might have earnings before taxes, earnings after taxes, and then you simply add the taxes back in to get to the earnings before taxes, right? Instead of going from the operating income minus the interest. So depends on kind of where you stand when you're reading these two line items. But once you have the numerator and denominator, we can then divide those two out. So we can just simply say then, we're going to have the 250,000 divided by the 180,000. We're still at the 1.3888, or rounded to 1.39. No change for the degree of financial leverage. Was a change with the degree of operating leverage. So then if we then go down to the degree of combined leverage, we look at the combined leverage then, we have a couple ways we can calculate this. One, we can simply multiply the degree of operating leverage times the degree of financial leverage. So if we go to our first scenario before we made any changes, and we just multiply these two together, we say the 2.4 times the 1.39 about, we get about 3.33 on the degree of combined leverage. You can also calculate that, the degree of combined leverage in and of itself, by saying that we're going to take the contribution margin. So we'll do the same calculation as we saw it in the past. We're going to take the units sold. We're going to take the contribution margin per unit, the unit price minus the variable cost. This is back to the original data. We have the unit price minus the variable cost per unit. That's going to give us our $50 contribution margin per unit. We're going to multiply that times the 12,000. That's going to give us our 600,000. So there's our contribution margin numerator. And then in the denominator, we have the earnings before taxes. The earnings before taxes then being this 180,000 here. So we got the contribution margin divided by the earnings before taxes. And that's going to give us our 3.33 once again if we were to divide that out. The 600,000 divided by the 180,000. Notice again, it's 3.333 on and on because there is rounding that will be a factor with these items. Now, if we took a look at the scenario 2, then, where we made the change, still have the same operating income or earnings before interest and taxes, but now changing the cost structure, variable costs now being only $10 per unit, whereas the fixed costs are now at the 710. If we did our combination between the two there's two ways we can do it to get our combined leverage. We can multiply the degree of operating leverage and the degree of financial leverage together, which would be the 3.84 times the 1.39. That gives us about 5.33. There is rounding involved again because these two items will have rounding. So that's one way we can do it. We got the 5.33, which is of course higher than the 3.33 we saw before. And that means that there's more leverage, more risk, also more possible, benefit in the case of good times, more problems in the case of a decline time, typically with the higher leverage. Why is there higher leverage? Because the degree of operating leverage went up because of the cost structure going up on the fixed cost side versus the variable cost side, and then the degree of financial leverage stayed the same, because there was no effect on the debt, and there was no effect on the operating income, and therefore that increased the operating leverage, increased the combined leverage. All right, then we can calculate that again. We could say, okay, we can also calculate it by taking the contribution margin. So that's going to be the units times the contribution margin per unit price, minus the variable cost per unit. Now we have $80 as opposed to what I believe it was 40 before. That's going to give us the 12,000 times the $80, or 960,000. 960,000 divided by the earnings before taxes, that being the 180,000. And if we divide that out, we're going to get back to our 5.33. So that's another way we get back to, once again, the 5.33. Lastly, we'll take a look at our break-even analysis, so you can kind of see how this ties into these kind of calculations as well. This is all basically break-even type of analysis. We're going to look at the break-even point in units. We've seen this a couple different times, or many different times, so we'll do it fairly quickly here for our two scenarios. So we got the break-even point in units. That's going to be the fixed costs. The fixed cost is going to be the 350,000. We're going to divide that by the contribution margin per unit, which is going to be the unit price, 90 minus the 40 for the original, and that's going to give us the 50 units. So 50, that's how much we're coming away with every unit sale, $50 after the variable costs. So then if we take the 350,000 divided by the 50, then 7,000 units then would take us to our break-even point on the first scenario. Now in the second scenario, you can see that we then increased the fixed cost as in relation to the variable costs, resulting in the same operating income. What happens to the break-even point? The fixed costs are now at the 710,000. Contribution margin per unit, now price is going to be $90, stayed the same, but now the unit cost is $10. So the contribution margin is now 80. And if we take the 710 divided by 80, we would have to produce more units to get to that break-even point, which would be 8,875. Now, it's very useful to see how the interplay between all these, the break-even points and the leverage calculations work. The way to do that is to work this in Excel. Highly recommend working this problem in Excel. If you set it up correctly, then you can change your data very easily, and you can start to manipulate your data and get a good understanding of what these relationships mean, what will happen when there's changes to a component within them.